The U.S. job market is showing signs of improvement. Fewer Americans applied for unemployment benefits last week. According to the Labor Department, jobless claims fell by 15,000 to 214,000 earlier this month. The government reported 678,000 jobs were added in February, and that's the largest monthly total since July of last year. All of this good news comes as the Federal Reserve says it will raise interest rates by at least a quarter percentage point to fight rising gas prices and inflation. Most officials expect that it will eventually be hiked to at least the level before the pandemic hit 2 years ago. For more on all of this, we want to bring in Ted Rossman. He is a senior industry analyst at Bankrate.com. Ted, good to have you here. So tell us, how will the rate hike affect everyday Americans, and how is it going to impact inflation and unemployment, and how quickly is all of that going to take place?
Well, first of all, this interest rate hike is probably the first of a series.
Right.
So the Fed's own projections say that there may end up being 7 of these quarter-point hikes by the end of the year. We'll have to see, but the general theme here is that the economy no longer needs these low crisis level interest rates. So I would point out that rates are rising for the right reason. Economic growth has been good. The job market's doing well. The Fed basically is trying to get a lid on inflation here, is really what they're trying to do. It's going to affect consumers most if they have variable rate debt. So that includes credit cards, adjustable rate mortgages, and home equity lines of credit. Those are going to be going up.
Yeah, and Ted, as you mentioned, and we've been reporting, obviously yesterday the Fed announced that they expect to raise interest rates at least 6 more times this year. We expected that actually to take place over the next 2 years, industry analysts said before the announcement. All of that's expected to try and tamp down inflation. But how much is there a possibility that it could do the opposite, trigger a recession, trigger stagnation? I mean, how much of this is a guarantee?
There's not much guaranteed right now. Everything's written in pencil. The Fed is really taking this one meeting at a time. The other thing they have to do, too, is to unwind some of their balance sheet. They've just pumped so much liquidity into the bond market. So there's really a lot going on here. We thought we were starting to get a handle on inflation. And then, of course, Russia's invasion of Ukraine has brought a whole other set of circumstances. So it's not just COVID and the supply chain anymore. Now it's higher fuel prices, it's geopolitical concerns. There's a lot of uncertainty out there. All of that said, the Fed probably should have moved earlier. I think they would even say that in hindsight, that the economy's been expanding robustly over the past year and a half. Unemployment is way down. The Fed does seem behind the curve here. So it definitely seems like time to get rates moving up. So I would expect a series of these. Pay down that credit card debt, refinance if you haven't already into a fixed rate mortgage. These are some things that we can do.
Sure, because those interest rates are just going to continue to climb. Ted Rossman, thank you.
Thanks for having me.